Hi, welcome to the second part of valuation of goodwill. In the first part we have studied a brief introduction of goodwill and future maintainable profit. And in this part we will complete 4 more simple problems and 2 advanced problems. Before starting advanced problem, we have already calculated future maintainable profit. And in this topic, we cover advanced topics on capital employed. What is capital employed? In simple questions, capital employed will be given like this. Mr. A has invested a sum of rupees 4 lakhs in his own business, which is a very profitable one. The annual profit earned from his business is 78,000 rupees. Only 1 year profit is given. You understand the concept behind the valuation. What is super profit? What is fair remuneration of the proprietor? Why it is provided? What is a non-recurring expense or loss? What is a non-operating expense or loss? What is a non-operating income? What is the impact of these items in the future profit? If in any year, if a business incurs a non-operating loss, that loss should be added back to the profit to find out future profit. In the future, this non-recurring loss never happen again. That is why it is added. Likewise, if any income is received, non-operating income or non-business income, both are same. That income should be deducted from the profit since it is included in the year's profit. And there are different methods of valuation of goodwill that we already covered. There is no need of repeating all these things again and again. And here it is saying 4 lakhs he has invested. That is capital employed. In simple questions, capital employed will be given. The annual profit is 78,000 rupees and which includes a sum of 10,000 rupees received as compensation for the acquisition of a part of business. Part of business premises. And this is a non-operating receipt, non-operating income. And in the next year or in the future, this income never recur also, as well as it is a non-operating income. In coming years, he can maintain only operating profit. This compensation will never receive again. So this income should be deducted from the year's profit. Here only 1 year is given. So from 78,000, this 10,000 rupees should be deducted. You know that. Compensation for acquisition of a part of business premises. So 78,000 rupees, we can write like this. Profit for the year. Profit for the year. 78,000 plus non-operating profit. Non-operating profit. 10,000. 68,000. Okay, correct? Then the money could have been invested in deposits. Which money? This 4 lakhs. The money could have been invested in deposits for a period of 5 years and over at 10% interest. And we have studied about yield expected by the investors. Yield expected. Normally this yield is an average investor expects from his investment. Instead, investing in the business, he could have earned or he could maintain certain amount as a interest. That is pure bank interest. This pure bank interest plus certain percentage as risk return. That may be called as yield. So here saying money could have been invested in deposits for a period of 5 years and over at 10% interest. And again saying considering 2% as fair compensation for the risk involved. It is called a yield. The definition is given in the question directly. Pure bank interest plus a 2% as fair compensation for the risk return. Risk involved in the business. Risk taken. When the business risk increases, return also increases. When the risk decreases, return also will decrease. And there is a risk return trade-off point where the risk is minimum and return is maximum. That is a risk return trade-off point. We have a separate topic for that. Investment decisions. Which decision is the best decision in the business? Risk return trade-off point. Where the risk and return trade off in a particular point. That point is called a risk return trade off point. So here Mr. A has invested a sum of rupees 4 lakh in this business. This is a capital employed. And the normal rate of return also given 10 plus 2, that is 12%. Normal rate of return is equal to 10 plus 2 is equal to 12%. Correct? And himself could earn 8,000 rupees per annum in alternative employment. That is fair remuneration of the proprietor. That also should be deducted from the adjusted profit. First, each year's profit should be adjusted. Then average is taken out. Here there is no need of making an average. Only 1 year's profit has been given. So all these assumptions forms a part of your answer. That is required in higher classes. So we can calculate everything. See? Average future minimum profit calculation. Profit has given 78,000 less non-operating income 10,000 rupees. Okay? Compensation received 10,000 rupees. That is a non-business income or non-operating income. We got adjusted profit. Less expenses likely to arise in future. We have studied that. Future items should be adjusted from the added or deducted from the average adjusted profit. That is a professional way. So fair remuneration of the proprietor is given 8,000 rupees. Deducted future maintainable profit we got 60,000. Normal rate of return given in the question. Pure bank interest plus 2% as risk return. It is 12%. Capital employed is also given. What is the amount of capital employed? Mr. A has invested a sum of rupees 4 lakhs. So capital employed is 4 lakhs. 4 lakhs. Which method we have to choose here? Goodwill always mean a super profit. So super profit method we can apply here. What are the different variants of super profit method? Capitalization of super profit and purchase of super profit method. Here purchase price is not given, so we can take capitalization of super profit method. So capital employed 4 lakhs, normal return is equal to 12% of 4 lakhs, that is 48,000. Super profit is equal to FMP minus normal profit, that is 48. we got super profit 12,000. If it is multiplied with the number of years purchase price given in the question, this is goodwill as per purchase price. Purchase price is not given. So we should assume it is capitalization of super profit method. Okay. So capitalization of super profit is equal to super profit divided by normal rate of return. That is 12,000 is the super profit. 12,000 into 100 by 12, we will get a goodwill 1 lakh rupees. Next question. The following particulars are available in respect of the business carried on by Mr. X. The profits earned by X 2018, 2019 and 2020. These are profits given. It may be first adjusted. Adjusted profit should be calculated. With this adjusted profit, we have to calculate average profit. While calculating average profit, see whether weights are given in the question. If weights are given, this adjusted profit should be multiplied with the weights assigned. Then calculate the average profit. From the average profit, all the future items should be adjusted once. Otherwise, before calculating the average profit, you write all the future items in all the columns, then adjust it. So profits given 2018 52,000, then 2019 49,000, then 2020 51,000. Calculation of future maintenance profit. Tax effect is not there. Simple question. In the year 2019, a fire occurred in the godown and stock worth rupees 1,000 has been lost. This is a past adjusted item. The stock was not insured and now decided to insure the stock. Oh, right. The premium on insurance estimated at 600 per annum. 600 per annum. A fire occurred, loss by fire. What to do? It is a non-operating loss, or let it stands to recur. So this loss by fire should be added to 2019 profit. 2019 profit. 2019 add loss of stock by fire. And now it is decided to insure the stock against fire. These are expenses likely to arise in future. Expenses likely to arise in future. Future management cost. These are all expenses likely to be arised in future. So premium on insurance 600 rupees should be deducted from each year, or you may deduct once from the adjusted average profit. There is no hard and fast rule for that. It depends upon you. So 600 rupees to be deducted from average adjusted profit or deduct from each year given in the question. Then next saying profits of 2018 include 2,000 income from non-trade investment. Non-trade investment means non-business investment or non-operating investment. All are same. We are calculating future maintainable operating profit, the profit that can be maintained in the future. This non-trade investment income should be deducted. While calculating capital employed, this non-trade investment, the amount of non-trade investment should not be considered in the capital employed. The asset side approach is followed. The amount of non-trade investment should be excluded. If share capital plus reserves we are taking, from the share capital plus reserves and surplus, the non-trade investment amount should be deducted. It is not represented. Okay, that we will discuss later, study later. The profits of 2018 include 2000 income from non-trade investment. So less non-operating income from non-trade. That should be deducted from 2018 profit minus 2000. Okay. Then fair remuneration of the proprietor, 10,000 per annum should be provided for. It may be deducted from average adjusted profit, or you have to show it in each year separately. The profits of 2019 included profit on sale of machinery. Profit on sale of machinery is a non-operating profit. Best example of non-operating profit. The sales and purchase of machinery is not an ordinary business, or it is an extraordinary item. If it is an extraordinary loss, that should be added back. If it is an extraordinary gain, that should be deducted. So profit on sale of machinery in the year 2019 is a non-operating profit or an extraordinary profit. So that should be deducted from 2019 profit. That is an adjusted item. Then the capital employed in the business is 3,50,000 and NRR is 10%. Normal rate of return is 10%. That is directly given. Value goodwill on the basis of 2 years purchase of the super profit. Okay, we can calculate that. So profits as given 52, 49, 51,000. So each year's profit should be adjusted with the past items. Past items are what? Loss by fire. 1,000 rupees should be added to 2019 profit. Income from non-trade investment 2018, 2,000 rupees. That should be deducted minus. Non-operating or non-business profit. That should be deducted. Why these items are deducted or added? That should be studied. Why it is deducted and why it is added. So why it is deducted and why it is added? We are calculating future profit. So future operating profit. So income from investments, non-trade investments should be deducted. Profit on sale of machinery is a non-operating profit. So that also should be deducted. That is in 2020, 1,000 rupees, that is deducted. Then fair remuneration of the proprietor. Less fair remuneration of the proprietor. In some questions it will say future management cost. So old management cost should be added back and future management cost should be deducted. Director's remuneration may be given in the question. The last year's director's remuneration should be considered always. If different amounts are given, that should be added to each year's profit. Then the new management cost should be, or new director's remuneration should be deducted. So in case of companies, it may be either future management cost or a new remuneration fixed. The fair remuneration of the proprietor. In case of sole tradership, it is 10,000. Here no tax adjustments are there. Then less insurance premium, 600 rupees. So 10,600 rupees should be deducted. We get an average future maintenance profit. Instead of this 10,600 rupees should be shown in each column. It may be like this. See. Less fair remuneration of the proprietor, 10,000 deducted. Insurance premium, 600 rupees deducted from each year. arrive at the adjusted profit. Here, adjusted profit is how much? 50,000. Deduct 10,600, we get 39,400. And here also 39,400. Divided by 3, we get an average profit. Here also average profit is 39,400. Future maintainable profit. So purchase of super profit method. There are two methods here. Super profit into number of years purchase price. So first calculate super profit. Super profit is the excess of future maintainable profit over normal rate of return. So capital employed should be considered. What is the capital employed given in the question? 3,50,000. So super profit is equal to average future maintainable profit minus normal profit. Normal profit is 3,50,000 into 10%. So 39,400 minus 35,000, 4,400. 4,400. So goodwill under purchase method is equal to super profit into number of years purchase price, 8,800. Then capitalization of super profit is equal to super profit by normal rate of return given in the question. It will be 44,000 rupees. You know that all this. Next. So following particulars are available in respect of business carried on by a trader. Profits earned is given. Normal rate of profit is 10%. Capital employed is 3,20,000. So normal profit is normal profit is how much? 32,000. Correct? 32,000 rupees. Normal profit is 32,000. Then we have to calculate future maintainable profit. Future maintainable profit 48,000, 61,000, 57,000. Write it. What are the past adjusted items, if any? Profits included non-recurring profits at an average of 3,000 rupees, out of which it was deemed that even non-recurring profits had a tendency of appearing at the rate of 1,000 per annum. That is a recurring profit. Non-recurring profit is 3,000 and out of this 1,000 rupees may recur in the future. So here non-recurring profit. So calculation of average future maintainable profit. The profits already given 48,000, 61 and 57,000. Less non-recurring profits. 2,000 rupees should be deducted. 3,000 is the non-recurring profit, but in the question saying specifically out of 3,000 rupees, 1,000 rupees has a tendency to recur. So here non-recurring profit is only 2,000. So deduct 2,000, we will get 46, 59, 55. Only one item to be adjusted. So average profit is equal to this adjusted profit divided by 3, that is 53, 333. Normal rate is 10% of capital employed. Both are given in the question. 10%, capital employed 32,000. So normal profit is 32,000. Average future maintainable profit is 53. So 33,000 minus 53,333 minus 32,000. How much it is? 21,333. So goodwill under annuity method, what is that? Super profit into annuity rate given in the question. 21,333 into 3.78. Under 2 years purchase method, 21 to 333 into 2 years. 41,666. Capitalization method, 21,333 by 10 into 100. Okay. So another question. Consider the following figures for the 5 years ending 31st March 2004. 31st March is the accounting year. 99, 2000, 1, 2, 3, 4. 5 years are there. Profit after tax is given. See, PAT is given. 61,046. Taxation provided in each year has been given. So while the valuation of future maintainable profit, the start point should be profit before tax. If profit after tax is given, add to this the taxation already provided. If it is at a fixed rate, we can simply gross it up. Here, each year's taxation is different. So, each year's profit should be added with the relevant taxation amount. Got it? We have already studied it. So, 61,000 add 20,000, 46, so on. Transfer to reserve is given. This transfer to reserve is a below the line item or an appropriation of profit. No relevance in the calculation of future maintainable profit. From one pocket, simply transfer to another pocket. So that is not considered. Director's remuneration. This director's remuneration is an expense. It is a charge against the profit and loss account. Okay, let's see. One of the fixed assets where depreciation at 8% has been provided, but a revaluation of the assets shows an appreciation of rupees 2 lakhs. And these type of informations may come. In the capital, by calculating capital employed, all the assets will be revalued, both fixed assets and current assets. If current assets are revalued, these informations may arise. Closing stock is undervalued, overvalued, like that. A distinction should be made between capital items and revenue items. An accountant should always keep it in mind while calculating these expenditures. A distinction should be made between capital and revenue portion. Here, one of the fixed assets where depreciation at 8% has been provided shows an appreciation of 2 lakhs. This is a fixed asset. Appreciation in the value of fixed asset is a part of capital reserve. Nothing to do with profit and loss account. That means profit on revaluation of fixed asset is a capital item, and while calculating future maintainable profit, this profit should not be considered. But this profit to be considered, that will be studied later. Capital employed. There are two approaches are there. Net worth approach, that is share capital plus reserves and surplus, liability side approach and asset side approach. In the asset side approach, all the assets are revalued. A revalued figure should be taken into account. But there is a revenue portion in this profit. When the fixed assets are revalued, land is valued at 2 lakhs rupees appreciated value. And there is, if it is a land, no depreciation is there. But if it is a fixed asset where depreciation is provided, the profit on revaluation may arise. In such cases, a case of additional depreciation will arise. Additional depreciation. So here 8% has been provided on this fixed asset and it is appreciated by 2 lakhs rupees. So in the future, annually 16,000 rupees depreciation will arise. And this depreciation is a charge against revenue. It is treated as an expense likely to arise in future. Got it? So 16,000 rupees is additional depreciation to be provided for, and expenses likely to arise in future. But this profit on revaluation 2 lakhs, nothing to do with the profit and loss account. That means future maintainable profit. Very important. A distinction should be made between capital and revenue item. So here additional depreciation will come. Additional depreciation. Rupees. How much it will come? 8% of 2 lakhs, 16,000. Okay. And this additional depreciation should be deducted from average adjusted profit. Or you have to show it as a deduction in each of the columns. Then next point, closing stock for the year ended 2002 was overvalued by 8,000 rupees. Overvalued by 8,000 rupees. So 8,000 rupees closing stock is overstated. If closing stock is overstated, what is the result? Profit is overstated. So that should be deducted from 2002 profit. If 2002 closing stock is overvalued, then 2002-3 opening stock is also overvalued. If opening stock is overvalued, what is the result? The profit is understated. The profit for the year 2002-3 is understated by 8,000 rupees. Here overstated by 8,000 rupees. Got it? The next point, on 1st October 21, the machinery costing 4,000 was purchased. Additional machinery was purchased, but wrongly charged it to revenue account. So what is the effect of this information? In October 2001, so it is the accounting year 2001-2. In 2001-2, a machinery, a fixed asset has been purchased that has been charged to revenue. That means this 4,000 rupees has been treated as an expense in the year 2001-2. So this 4,000 rupees should be added to the 2001-2 profit. Got it? And then if a revenue item is treated as a capital item, what will be the effect? If depreciation is there, that depreciation should be taken into account. So here, 1st October 2001, machinery costing 4,000 was purchased but wrongly charged to revenue. No effect has not yet been given for rectifying the same. We have to rectify it. This 4,000 rupees should be added to 2001-2 profit. 4,000 rupees. Then depreciation on 4,000 rupees at the rate 10% per annum on written down value. That should be provided from October 2001 to account to 3 and 4. Depreciation should be calculated separately and deducted from the each year's profit. The next is new taxation rate may be taken at 40%. New taxation rate 40%. So we will start with the profit before tax. Here profit after tax is given. Write all the profit after tax then add back the taxation already provided. We get a profit before tax. To this profit before tax, all the past items is to be adjusted. Here only few items, no? We can write it directly. Transfer to reserve is not considered because it is just a appropriation of profit. Nothing to do with the future maintainable profit. But there is a hidden point here. See the director's remuneration. Director's remuneration in the year 99, 2000, 2001, 2, 3 and 4 is given. For the first 2 years it is 4,000 each, then 5,000 each, and in 2003, 4, 6,000. Here we have to give one assumption. Here nothing is mentioned about director's remuneration. Fair remuneration of the proprietor or a future management cost is very important while valuation of goodwill. It is to be assumed that last year's director's remuneration is to be provided for the subsequent years, if nothing is mentioned. But if an additional information says director's remuneration is to be provided at 8,000 rupees per annum, then what we can do? All these years' profit, director's remuneration should be added back to corresponding year or years, and then 8,000 rupees to be deducted from average adjusted profit or each of the years. This is a hidden point. 6,000 rupees was the last year remuneration. Normally directors' remuneration are fixed at the annual general meeting. It may be increased or may be decreased. So we need to calculate future maintainable profit. Right? Tax, profit after tax, and taxation. Then these should be added back to each of the years. So this 4,000, 4,000, 5,000, 5,000, 6,000 should be added back to the corresponding years. Then depreciation at 8%. Additional depreciation we have calculated already. 16,000. Closing stock we know. 1st October, a machinery costing 4,000 was purchased. Okay. We already discussed it. 4,000 rupees should be added to 2001-2 profit. A capital item treated as revenue. The profit is understated. So that should be added back. Then depreciation on 4,000 rupees for half year should be provided for the first year, and a full year or year should be provided for the subsequent year and years. So here it will come 4,000, 10%. 400 rupees per annum, then 6 months, 200 rupees for first year. Then 3,800 is the balance, written down value method following. So second year 380 rupees will come. And third and subsequent years, you have to calculate it. No effect has been given for rectifying this. The new taxation rate taken at 40%. From the average adjusted profit, deduct additional depreciation, we will get a future maintainable profit. Otherwise, rupees 16,000 you have to write it in all the years. Okay, we will do. Profits and taxation, profit before tax we got. If taxation rate earlier was say 50%, we can simply gross it up. All the years profit is grossed up. We will get the profit before tax. Here different tax amount is given, so that should be added separately. Then add a director's remuneration provided earlier. Here we have given an assumption. The last year's remuneration to be continued in the future years. If there is a change, the new figure should be deducted after that. Then less overvaluation of closing stock, 8,000, undervaluation of opening stock should be added back. Overvaluation of opening stock should be added back. Add machinery treated as revenue item. Purchase of machinery, capital expenditure treated as revenue. So the profit is understated. So that should be added back. Then on this value, depreciation is to be provided first year, 6 months, October to 31st March 2002. Here full year, full year. So on the written down value, you know that various methods of providing depreciation. That should be adjusted. So we have calculated it. Then adjusted profit we got. Adjusted profit should be averaged and from that deduct additional depreciation. Additional depreciation should be deducted from adjusted average profit. To this, any future items should be there. That should be adjusted here. What are all the future items to be treated here? Additional depreciation and director's remuneration. That is why we have added back the director's remuneration. Here we have given one assumption. Assume the director's remuneration will be 6,000 rupees in the coming year or years. If there is a change, that changed amount should be taken into account. So here average profit, all the 5 years profit added, 430,078 divided by 5, you will get average profit. Average adjusted profit. Deduct expenses likely to arise in future. Here depreciation, additional depreciation. Additional depreciation how much? 16,000. Otherwise 16,000 you have to show all the 5 years as a deduction. Additional depreciation how much? 16,000. So all the revenue items we have calculated. Now, director's remuneration is there. Less director's remuneration. How much here? 6,000. Equal to this minus. So we got adjusted average adjusted future maintainable profit. Future maintainable profit. Average adjusted future maintainable profit. From that deducted tax. Less taxation. The new rate of taxation is at 40%. It's already mentioned in the question. At the rate 40%. This into 40%. That's taxation we got. Future maintainable profit is equal to this minus this. F1. Future maintainable profit after tax. So we will start with the profit before tax and end with the profit after tax. Otherwise, you have to take all these adjusted items in their net tax figures. Net tax figures. Some questions are there in the text. I have taken all the expenses should be adjusted with the 40% tax rate. Expenses and incomes. $1 and 1 rupee never becomes 2. I have $1 and 1 rupee, adding together never becomes 2. The values amount should be comparable, amount should be compared. An accountant should always keep it in mind. A dollar and a rupee never becomes 2. So we can calculate capital employed. Capital employed means what? Assets minus liabilities. The parties to a business we studied in the introduction. Assets minus assets at new values less liabilities assumed. The definition also we have studied it. So here what are all the assets? Land and buildings. Revalued figure should be taken into account. Here land and buildings 1,40,000 is shown. And on the liability side, depreciation fund 20,000 land and buildings. And in the information showing value of land and building is appreciated by 1 lakh rupees. So it is appreciated by 1 lakh, not appreciated to. So 1,40,000 plus 1 lakh, it is wrong to say that because there is a depreciation fund appearing on the liability side, 20,000. So this appreciation or depreciation should be calculated with regard to book value. What is the book value of land and building? 1,40,000 less depreciation. So indirectly some values will be given. So here book value of land and building is 1,20,000 and this land is appreciated by 1 lakh rupees. This accounting text, when you read it carefully. Lot of hidden informations will be there. So land and buildings we can take. Land and buildings, land and buildings. New value should be taken. Here book value, what is the book value of land? 1,40,000 minus 20,000 and it is appreciated by 1 lakh. So we can say that 1,40,000 minus 20,000, that is how much? 1,20,000 plus it is appreciated by 1 lakh. 1 lakh is equal to 2,20,000. 2,20,000 rupees. That is the value of the land and buildings. Okay, got it? But if the new value is directly saying here, no problem, that can be taken directly over here. It is indirectly saying value of land is appreciated by, increased by 1 lakh rupees. So what is the book value of the land? 1,40,000 less depreciation fund showing on the liability side. So indirectly lot of informations will be given in the question. The book value and the new value, that is the difference. That difference is the profit or loss on revaluation. So on the asset side approach, if we are following, take all the new values or fair values of the assets. So here land and buildings is 2,20,000. How it is got? 1,40,000 less 20,000, that is the book value. Appreciated by 1 lakh, add that appreciation, we get a 2,20,000. Then what is the next asset? Plant. Plant at cost. What is the value of the plant? 1,35,000. What is the plant depreciation? 30,000. So 1,05,000 is the book value. Book value 1,05,000. What is the revalued figure? and the market value of plant is 95,000. Here market value of the plant is directly given. So if it is directly given, that can be taken directly into the statement of capital employed. So here 95,000 is the value of the plant. Value of the plant is 95,000. And there is a loss on revaluation of plant. How much is the loss? Book value is 1,05,000 and 95,000 is the revalued figure. There is a loss on revaluation of plant. While calculating future maintenance profit, there is a savings in respect of depreciation on plant. Here loss on revaluation of plant is 10,000 rupees, and if the depreciation rate is 10%, we can say 1,000 rupees is the excess depreciation. Not additional depreciation. Excess depreciation provided. That should be added back to the profit for the years to arrive at future maintenance profit. And here there is an appreciation of 1 lakh rupees. It is a capital profit. Nothing to do with the future maintenance profit. And the depreciation on the appreciation. Depreciation on the profit on revaluation. That is an additional depreciation. That depreciation is a part of revenue. So additional depreciation should be deducted from FMB, and excess depreciation provided should be added back to the year's profit. So land and buildings we have taken, plant we have taken. The next one is current assets. Nothing is mentioned over here. So current assets taken at book value. How much? 2,70,000. Then investments. Investments may be non-trade investments and trade investments. Only trade investments are considered here. Why only trade investments? Because we are calculating operating value of the business. How much capital employed in the business for earning revenue. The investments are non-trade investments. It is not a part of trade, that is operation. So the income from investment should be deducted from the year's profit while calculating FMB, and the amount of investments, non-trade investments, is not considered or not included in the part of capital employed. Here investments saying 50% of the investments are 10% non-trade investments. 50% of the investments are 10% non-trade investments. So only 50% of the investment should be included here. So investments how much? 90,000. Less 50%. That is 45,000. And he is saying 50% of the investments are 10% non-trade. If we calculate FMB in this question, 45,000 is the 50% of investments. So it is 10% investments. So 10% of 45,000 is non-operating income. That should be deducted from the profits. We will be very careful while reading questions. So many hidden informations will be there. So while calculating capital employed, only trade investments are considered. Only trade investments. Example of a trade investment is depreciation fund investment or investments for the replacement of the fixed assets. It may be trade investments. So here in this question only capital employed we have to calculate. We are studying capital employed. If FMB is there, we have to deduct 10% of the non-trade investment. That is 4,500 rupees to be deducted from the year's profit. Okay, got it? Then investments only 50% here to be considered. We can write it here 50%. In other investments, patents, copyright and trademarks are always considered. These are intangibles but as having certain value. These are allowed to be shown in the balance sheet. These are identified intangibles. So that can be taken into account. Patents, copyrights, then trademarks. Trademarks 7,000, copyrights 3,000, and patents 10,000. So capital employed, assets taken over at revalued figures, which include intangibles, but does not include value shown in the books and deferred expenditures. Okay, this deferred expenditure is always excluded from net worth. Always, even in for other purposes also, these deferred expenditures are not considered. For all purposes, hereinafter net worth is the subject matter. Holding company accounts, etc. So, lot of topics are coming. Net worth is there, valuing there. Net worth is the value of the business. Net worth means net assets. But for valuation of goodwill, non-trade investments are considered. But for valuing the total net worth of the company, all investments will consider. And goodwill also to be considered for valuing shares for net worth purpose. So assets taken over, from that deduct liabilities to third parties. We already studied this valuation of goodwill is an affair between the business, the first party and the second party owners. And from those deduct liabilities assumed. Liability assumed are 7% damages, current liabilities and a workmen profit sharing fund. Workmen profit sharing fund is a third party liability. But workmen compensation fund is a part of accumulated profit, reserves and a surplus, part of net worth. And this is the asset side approach for calculating capital employed. 2 years balance sheet may be there. So opening net separable assets and a closing net separable assets divided by 2, we will get what? Average capital employed. Opening plus closing by 2. Simple average capital employed. If opening balance sheet is not given, the assumption is that introduction we have already studied. Very clearly I said the net worth increases, that means net asset increases primarily because of profit earned during a period. Recall it. Net worth increases due to profit. If there is no additional capital, only the profit increases the net worth of any business. Only the profit increases net worth, capital. So here, all the assets taken over, all the assets revalued will be considered, and from those deduct third-party liabilities. And these are all the third-party liabilities. Oh, sorry, current liabilities we have taken. Current liabilities, workmen profit sharing fund, depreciation fund is deducted from here. 7% debentures, current liabilities. You have considered profit sharing fund, current liabilities, 7% debentures. These are all third-party liabilities. Third-party liabilities deducted, we got a net separable assets. Okay. In other ways, The other approach is liability side approach. Capital plus reserves and surplus. All capital should be added. Capital and reserves and surplus added. From that, deduct loss on revaluation, add profit on revaluation, and assets not represented, that is intangible deferred expenditures, that should be deducted, and 50% of investments. The same answer we will get. And if 1 year balance sheet is given, then we have to assume profit for the year we have to calculate. And one assumption is giving there. The assumption is that the profit has been earned evenly throughout the year. If it is evenly earned, we have to calculate weighted average. Normally these are not given in the question. But we have to expect. We have to expect anything in the examination. And this is the capital employed. Very simple. Opening capital and closing capital is calculated and take the average. Otherwise, only 1 year balance sheet is given. Find out the net separable assets. Net separable assets means what? Excluding goodwill and deferred expenditures, and take all other assets. It may include intangibles also. All other assets at new values. And while valuing, both fixed asset and current assets may be revalued. Liabilities also revalued. Included in the creditors an amount of current liabilities, and included an amount of rupees 5,000 is no longer payable. So the value of liability is only what? How much? 1 lakh rupees. Only 1 lakh will be deducted here. Included in the current assets, stock is overvalued by 10,000 rupees. Then stock we have to deduct 10,000 and only 2,60,000 will be shown here. And this is capital employed. Very simple calculation. Assets at revalued fair values. If that fair values will be given in the question. These are all examples. In real practice, this fair value calculation may take several weeks to complete. Regarding investments and all, market quotes may be there. But for valuing plant, etc., it will take several weeks to complete the process. These are all expectations only. Estimates, simply estimating, not liquidating. In the case of liquidation, realizable values, not even market value. But always not considered this deferred expenditures. And intangibles may become valueless in liquidation. Nobody will buy the goodwill shown in the books. Okay, take my goodwill and satisfy it. It is not possible. That is why intangibles, valuation of intangibles, the accounting standards clearly mentioned certain standard procedures there, identification. Only amount expended will be allowed to be shown in the books. So, if it is separable from goodwill, the separable assets are called these intangibles. It may be either acquired from outside, so a quote is there, may be shown in their cost price in the balance sheet. But some assets may internally raise the amount expended on research and development, technical know-how developed by the business. The amount expended on those may be allowed to be shown in the books, nothing more than that. If an intangible is showing in the books, say I have a goodwill of 10 crores and it is showing in the books, it unnecessarily inflates the net worth and thereby it will result in the unnecessary increase in the net worth and value of the business. And these goodwill, nothing can be realized at the time of liquidation. That is why very, very strict in intangibles. Very strict. But the business enjoys certain advantages which cannot be separated. So far as it can be separated, these are all included in the patents, copyright, trademark, brands, technical know-hows. And there only amount expended will be allowed to be shown. Or if it is purchased from outside the business, it may be shown at their cost. Okay, so we will come to some advanced problems. In all problems, we have to calculate capital employed. Average capital employed. Average capital means opening capital plus closing capital divided by 2. If only 1 year balance sheet is given, then what to do? Half of current profit should be deducted from closing capital, on the assumption that the profit has been earned evenly throughout the year. We are valuing intangibles, only assumptions are possible there. Above all assets, goodwill is there. Above all, God is there. Both are intangible. We cannot see or touch. Physical substance is not there. It's very difficult to value goodwill. But these patents, copyrights, trademark, etc., acquired from an outside source, what is there? But internally raised goodwill, there some restrictions are there. Not at all allowed to be shown in the balance sheet. Because it will unnecessarily increases net worth. That means unnecessarily increases the value of the business. The business real value depends primarily on the profitability. Profit. The profit increases the value of the business. Otherwise, additional capital should be brought in. Okay. So, we can solve some advanced texts. So, in this question, net separable assets are 4,55,000. If 10% is the normal rate of return, 45,500 will be the normal profit. The excess of actual profit over normal profit is super profit. And the method will apply. And the liability side approach also gives the same result. Do it yourself. Capital plus reserves and surplus. Add profit on revaluation of land and buildings. Deduct loss on revaluation of plant. And 50% of the investments also should be deducted. Because this capital, on the amount of capital, this 50%, that is 45,000, is not employed in the business. We are calculating business profit. We are valuing business. That is why non-trade investments are not considered. Non-trade incomes also not considered. Okay? So, let's do some advanced texts and solutions. Don't forget to subscribe and press the bell icon for more advanced solutions. By understand this concept of goodwill very well, you can expect definitely some questions in the examination. It's very important. Understand the concept. Don't by heart it. Non-trade investments are not considered. Okay, by heart it. That is not good. Understand what is behind this. Why non-trade investments are not considered. Non-trade investments are not considered because we are calculating business profit. And this profit is not on account of operation. Non-trade investment income is not on account of operating activity of the business. That is why non-operating income from investment should be deducted from FMP while calculating FMP. Non-trade investments is not considered as a part of capital employed. And these deferred expenditures are not employed in the business because of debit balance carry forward amount only it is showing here. So let's understand why it is not considered and why it is considered. In order to ascertain the real capital employed, the fixed assets should be revalued and take it at their value, new values, fair values. If a new person comes into the business, he have to invest that much money in the business. That is why assets are revaluing. It is from the point of view of an outside investor. So understand these concepts behind valuation. Okay? So, see you in the next part.